Hello everyone. Sorry, I just gotta still get set up here a little bit. Should only take a second. Alright. Hey Jason, hey Nicole. Hi Harry. Help? Well, maybe that was a Freudian slip. I can see it, Jason. Thanks. Hey Will. Hello. Alright, so we're gonna kind of get going here. I know we're still kind of getting spun up. So it's 9:45. This lecture is not going to be quite as long as the one yesterday, where I had to break it up into two parts. Revenue recognition, just um, really. Shashank, is that? I'm not sure if I'm saying that correctly. I see Shane and so Will. I hope I'm not pronouncing that too badly. Um, anyway, Shashank. Sha. Oh, okay. Shashank. Got it. So if I did Shashank. All right. Hopefully I got it, or close enough. Um, I'm trying. Anyway, so as we kind of work through it, this chapter, probably more than any other chapter we're going to do, is really conceptual. And so for some students, that can be a struggle when it comes to test taking. But I will say, compared to the previous five chapters, students typically perform the best on revenue recognition. So I'm pretty confident this will be a benefit to you all in terms of grade, but you also just need to continue to focus and continue to work hard, because I would hate for you to relax and all of a sudden miss an opportunity to earn a lot of points. And so let's kind of walk through revenue recognition. I don't know how long it'll take, but let's get moving. All right, so sorry, I wasn't quite on there. Some background. First of all, revenue recognition errors are a major cause of of financial restatements, and a lot of times it leads to litigation against firms and their auditors. Um, in fact, there's a lot of academic studies out there, which is what I do when I'm not teaching. There's a lot of academic studies that look at revenue recognition issues, and they kind of treat, I would say, most revenue recognition restatements as more serious than maybe other items. And so, revenue recognition is a big deal. People get fired over recognizing revenue the wrong way. Auditors get fired over missing issues with revenue recognition. So just be aware that maybe more than any other issue in accounting, revenue recognition is one of those that is always a major issue, and always one where practitioners struggle sometimes to do it correctly. So the FASB, which is the U.S. Financial Accounting Standards Board, and the IASB, which is the International Accounting Standards Board, they did agree on a common revenue recognition standard. It's been a few years since it's been in operation, but revenue recognition between FASB and IASB, or between the U.S. and IFRS, are exactly the same. And so the nice thing is, for this chapter, there's no IFRS sheet, because there's no differences. And so anything you see here that we talk about also applies to IFRS. Now, the new standard attempts to address any issues where there are either incorrect or inconsistent practices. And so I would say, under the old standard, there was a lot more variation in the way that things were applied. The new standard really allows for a little more flexibility in the application of the standards, but I would say requires more documentation for the way that you're applying the standards. So it's a little bit different. I would say there's again more flexibility, but I'd say there's a higher standard for documentation. So it's just different. Um, Standards do continue to evolve, and so just because this is the standard today, it doesn't mean that that's going to be the standard 5 years or 10 years from now. I think the standard is going to be around for a while, but it is something that can change, and certain industries will actually adopt specific guidance. And so just be aware that some industries will actually be more specific than what the general standard requires. So under the new revenue recognition standard, it is a 5-step process, and I'm just kind of lay that out here. The first step is to identify the contract with the customer, then identify separate performance obligations that are part of the contract. Then you need to determine the transaction price. You have to allocate the price to all the performance obligations, and then you recognize revenue as each obligation is satisfied. And so that is the 5-step process. And we're going to kind of walk through each one in turn, but just be aware, this is it. This is the new standard. All right, so step 1, identify the contract with customers. So a contract is an agreement that includes enforceable rights or obligations. Under the new standard, it's important to note that a contract can be written, it can be oral, or it can even be implied from customary business practices. And so I would say the preference is for a written contract, but it does not have to be written. Like I said, it can be oral, or it also can be implied. Another part of this, so there are kind of 5 components that the standard kind of highlights as having a valid contract. Number 1, there must be some sort of commercial substance to the agreement, meaning there needs to be some sort of economic transaction between the two parties. The parties do have to have approved the contract, so if they're still in it's a negotiation, or if all parties haven't signed off on the contract, it's actually not yet a valid contract. There needs to be the identification of rights for each party. So it could be right to remuneration, right to service, right to recourse. So there needs to be those rights need to be identified within the contract. There needs to be payment terms. Now, it doesn't mean that it has to be fixed. It just means there needs to be terms. There needs to be some idea of what the two parties are gonna pay. And then it also has to be probable that the consideration will be collected. This is just one where if there's a very low likelihood of collection because for whatever reason, then it's really not a valid contract. Really important here, so you can have a contract, but until somebody actually performs under the contract, there is no asset or liability. And so a lot of times, as soon as you kind of think like, oh, we just signed this big contract, which is great, especially if, let's say, like you're a business and you just got a new client, and it's going to be this great deal for you. But the issue is you can't really recognize any assets or liabilities until you or the other person starts performing under the contract. And as soon as a party starts performing under the contract, that's when contract assets and liabilities are created. All right, step 2. Identify performance obligations. So there can be one or more promises to perform under the contract. If possible, under the new standard, they prefer that goods or services be distinct. In other words, if there are multiple deliveries, they really want those to be distinct within the contract. It's sometimes difficult to do that, but just generally speaking, if you're as an accountant, or if you're asked to advise on how to structure a contract, having distinct goods and services is really important under the new standard for revenue recognition purposes. Sometimes this can be very, very straightforward, but sometimes contracts may include promises to perform that are intermingled and difficult to separate. So again, there is flexibility under the new standard, but documentation is important. So some examples are sale with a limited warranty or service agreement. So if I make a sale with like a 30-day money back guarantee, or a warranty promise, obviously then you have kind of 2 situations. You have the item, and then you have any obligation to provide warranty service. And so those really are 2 distinct performance obligations rather being one, even though it may be customary just to price it as one. Like, let's say the warranty is just included in the sales price. There would be some notion that you should separately price the 2, even though you've only given one price. There's probably the need to allocate between the actual sale and the warranty service. Um, it also needs to be important here that promises do not have to be explicit. And so, in other words, these promises to perform do not have to be explicitly written into the contract. They can be implicit, or they can even be customary. And so, again, while the preference is towards explicit performance obligations, it does not have to be explicit. So, as an example, a used car dealership may customarily detail the car before delivery or at the customer's convenience after delivery. So, in that case, the contract really does have two performance obligations: delivering the car and detailing the car. Even though it may not be written into the contract that they will detail the car, that really is a separate performance obligation. And while minor in comparison to the price of the car, if possible, there should be separately allocated, especially because the detailing may come at a later date. All right, let's walk through some examples. Um, so, so when a sports team sells season tickets, so in the chat, if you're able, um, what would be the performance obligation related to the sale of season tickets for a sports team? What's the performance obligation? This is from the sports team's perspective. To host the games. Mm-hmm. So Nicole's saying basically their obligation is to play the game. Any other ideas? To provide a seat at all games for the season. Allow the buyer to attend the games free of charge. And I think you're all kind of onto it. I mean, the idea here is basically let's kind of take an example. So we have then recognizing revenue until the season elapses. They have an obligation to sell tickets. And really it is, so the performance is, so you got to think about, okay, why did the person buy the ticket? They bought the ticket for the opportunity to attend the game. Now, basically in that situation, the sports team is obligated to provide an opportunity to attend the game. And so if you kind of want to think about it, each game is a separate performance obligation. So in other words, let's say that it's a football team, so the Carolina Panthers. So they play 8 home games every season. And so if you kind of think about it, there are 8 distinct performance obligations. There's the first game, second game, third game, all the way through. And so you could kind of think about allocating the season ticket sale to those distinct obligations. However, there may be other things that season ticket holders are entitled to that are outside those games. Maybe there are things like you can attend 3 practice sessions, you can go to this kids day, you can, there may be other things. And so now you've got to think about, okay, the games make sense, but is there value in some of these other things that are thrown in as benefits to buying those season tickets? And the answer is probably yes. And so your allocation gets more and more complicated. So even something simple like the sports tickets, the season tickets to a sports team, it can get complicated really, really fast. Um, so if all seasons are related to each other, you need only one time ticket. Usually the way that these work is you're given 8 tickets. And so basically you turn in your ticket each time you go to the game. And so again, even if it were just one ticket, like let's say a pass, having the pass is not the performance obligation. The performance obligation is playing the game. In other words, let's imagine a situation where you sell the season ticket and then you don't play the game. Well, actually, COVID-19 is like a perfect example of this, right? So you had basketball and baseball games where people had purchased season tickets. Well, why did they buy those season tickets? Not to have the piece of paper. That's not why they paid. They paid to play, to see the game being played. And so the performance obligation for the sports team really is that game. And so I could imagine some sort of allocation evenly over each game that's played, and then obviously with some allocation maybe to other items if there are some. But just be aware that even something like that can get really complicated. All right, so lawn service with aeration and fertilization service. So again, this is one of those things. Like for example, I actually have my kids mow my grass, so I don't pay them to mow, but I do pay someone to aerate and fertilize my lawn service. But we basically just pay like a quarterly fee. Well, how do they recognize revenue with that? So it's not necessarily when I pay the fee. For them, the performance obligation is you must aerate my lawn, you must fertilize my lawn, you must do those things. And so you could imagine a situation where they're like, okay, during this quarter he paid $100 to have us treat his lawn. Well, we're going to be aerating it on this day, we're going to fertilize it on this date, so let's allocate across those two performance obligations. And so again, it's identifying all the services and goods that are part of the contract, and each one of those distinct service and goods is a distinct performance obligation. So audit services for accounting firms. Think about this. So usually with an accounting firm, you're embedded. If it's a large enough client, you probably are going to work with them on an ongoing basis. And so, quarterly, you might be just providing a review. You might have some consulting services, and of course, then eventually you do have the audit. And so you got to think about all of those things. So whenever you contract out with that customer, well, what are the things that you've promised to do within that contract? And so you have to try to identify each of those performance obligations. And so again, it may be, okay, well, we're going to do an inventory count. We're going to do, whatever it might be. Those may all be distinct performance obligations. So again, whenever you talk about examples, it's really important that you try to distinguish separate goods and services. In some cases, it's very, very easy, and in other cases, it gets much more complicated. But that is the key under the new standard, is trying to distinguish separable goods and services. And one thing I will say is there is pressure to write contracts, again, where those separable goods and services are identified in the contract. So step 3 then is to determine the transaction price. So again, many times very straightforward. As an example, if I go to the mall and I buy a $30 sweater, it's fairly easy to determine that the transaction price is $30. There's really not a lot going on there. But certain situations can make it a little more difficult to determine the transaction price. And there's several that are highlighted in the book. We're going to kind of walk through each one. One is where there's variable consideration. The other is if there's like a delay in payment where you need to apply the time value of money. And then the other one is if there are non-cash considerations. So in other words, if there's an exchange of goods and services, but where cash is not part of the transaction. So each of these things can make it more difficult to determine the transaction price. So we're going to kind of walk through each one. And also, of course, if there's consideration paid or payable to the customer. All right, let's talk about variable consideration. So again, sometimes payment ultimately depends on rebates, bonuses, discount, performance. So there's a lot of things that can go into a contract that say, well, the range of payments can be, from this number to this number. And so it's not fixed, it's sort of a range. And we've got to figure out, well, how do we recognize revenue when we don't know for sure how much is going to be paid? So how do we report the amount when it's not known? There are two options under the new standard. You can either report the expected value or the most likely amount. And those are very similar, but not quite the same. So an expected value is, I would say, more like an average, so a mean. So if there are 20 different outcomes, well, let's just take the average, and that's what we're going to report. The most likely amount is really a specific amount that is the most likely to occur. So you might have 5 different outcomes, and let's say that one of the outcomes is 55% likely going to happen. Well, okay, that most likely amount then is what we would report. Again, they're both allowable under US GAAP. And it's just up to each company to determine which one is most appropriate for their situation. I will say, if let's say that The outcomes are like a continuous distribution. If you kind of imagine like a bell curve, where there's really not. It's kind of tied to performance. Let's just say you get a 1% bonus based on earnings for the next year or something like that. So that 1% could be really any range, and so that's a situation where you really would have to use the expected value because there's no one most likely amount. You just have to find sort of the peak of that bell curve. Um, Whereas with the most likely amount, if there are kind of a few distinct outcomes, I'd say the most likely amount is typically going to be the most appropriate method. But I want to be very clear here that this is the amount that's recorded at the time of the transaction, even before payment has been ultimately determined. So if I make a sale on January 1st, 2020, and there's some sort of bonus structure where, okay, I get $100,000 now and I get 1% of your profits for the next year, well, what we do is we actually record this revenue on January 1st because I've completed my performance obligation. Now, the payment has not been determined, but I'm going to record it based on either the expected value or most likely amount. In that case, if I was doing 1%, it would be the expected value. But anyway, in that case, I would record it all on January 1st. And then as I start collecting, we'd kind of reconcile it after the fact. But again, that's the whole idea here, is that you record this actually before the final payment is determined. One example of a most likely amount. So when we talk about a most likely amount, let's say as an example, what's a good example? I'm trying to think. All right, let's say that I'm a mergers and acquisitions advisor, and I contract with a customer who's selling their company. All right. What I can do is, let's say that their part of the contract says, okay, with the initial sales price, my commission, I get $150,000 for selling the company, and then the buyer also says, well, if our profits, depending on our profits, we're going to pay out either a $10,000 bonus, a $15,000 bonus, or a $20,000 bonus, depending on our subsequent performance. And so in other words, I, as the broker, could potentially get a bonus based on the company's subsequent performance. Well, what I'd look at those three outcomes, the 10, the 20, or whatever the three numbers were, and I would say, okay, which one of those is most likely? And so whichever one is most likely at the time of the transaction, at the time of the sale, I would actually be able to record that amount of revenue, the one that I think is most likely to occur. So it's like a situation where there's like these distinct outcomes, rather than, like, let's just say, oh, you just get 10% of the profits or something like that, which is more of a continuous outcome. Again, it's a kind of a made up example, but that's the kind of thing you'd want to look for. All right, the other thing is you must be reasonably assured that you're going to be entitled to the reported amount. So in other words, if there's a remote possibility that you're going to get a bonus, you're not really going to report that. So any of these outcomes that you're talking about, it must be reasonably possible that you're going to achieve those outcomes. Again, that's not a typical part of it, but I suppose it could be, where you sort of need to ignore remote sort of variable consideration. We only want those that are reasonably possible. All right, let's walk through an example. So 49er Company provides consulting services for the client for $15,000 on January 1st, 2020, but they also receive what's called a tiered bonus payment based on client firm revenues for the entire year. 49er has used this arrangement with many similar clients in the past. For this particular client, 49er expects to earn $10,000 with 55% probability, $5,000 with 35% probability, and $1,000 with 10% probability. How much revenue should 49er recognize as part of this transaction? And we're going to sort of assume that everything else has been met, just to kind of keep this simple. So let's look at this. So which transaction price should the firm assign to the consulting revenue recorded on January 1st? So the firm may choose to report the most likely amount. If they choose that, the most likely bonus is $10,000. And so in that case, they would report the $15,000 of fixed consideration plus the $10,000 bonus. So they would actually report $25,000 of revenue on January 1st. They may also choose to report the expected amount. And in this case, because there are three distinct outcomes, the expected amount would be like a weighted average. So you take the 10,000 times its probability, the 5,000 times its probability, and the 1,000 times its probability for an overall expected bonus. And so they would report, in that case, $22,350. Now, the reality is, the company could report either of these, and both of them would be acceptable under the new standard. I think as far as which one is most appropriate, it really depends. I would say, given that it's only a 55% probability, I think the $10,000, the $25,000 overall, the first one, is probably aggressive. It's allowable, but it's aggressive because basically 45% of the time, that's going to be too high of a number. And generally speaking, even though it's not formally part of the conceptual framework anymore, we want to be kind of conservative if we can. So for that reason, my personal opinion is that the expected amount would probably be the most appropriate in this situation. If that $10,000 bonus had a 90% probability, then I think that probably would be the most appropriate method. Again, there's judgment here. It's not to say that reporting $25,000 would have been wrong. It just would have been aggressive. $22,350 probably would have been the more conservative approach, and I tend to be a little bit conservative when I'm applying accounting principles, and so I probably would have gone with that. But I want you to understand, both are acceptable. Both would be acceptable under US GAAP and under IFRS. All right, so now let's talk about the time value of money. So sometimes payments are delayed, so the transaction price is complicated due to timing. So it's not the amount, it's the timing. So if there is a significant delay in payment relative to the transaction date, US GAAP infers that there is a financing arrangement. In other words, if there is a significant delay, US GAAP basically says, hey, you had a significant delay, you have a financing arrangement, and you must treat it as such. All right, so then given that there's this inferred finance arrangement, we got to think about the different components of this transaction. So first of all, you have the sales revenue. And basically the sales revenue is the present value of any of that future payment. So imagine that I'm getting paid $100,000 2 years from now. Well, $100,000 2 years from now is not the same as $100,000 today. And so given that significant delay, what US GAAP is saying, well, that $100,000 payment includes sales revenue, which is the present value of that payment, and anything above that then is interest revenue. And so basically they're just inferring this financing arrangement. And so then the interest revenue is any amount above the present value. The longer the delay, the more interest revenue and the less the sales revenue. So there's this trade-off between the two. So two things to consider. Again, we're going to kind of get into the nuts and bolts of this, and hopefully it'll make a little more sense when we do. But there are really two things to think about as we jump into this. Number one, significant should include any delay that is material. Now, when we talk about materiality under US GAAP or under IFRS, really what we mean is if it's important to decision makers. In other words, is knowing that there is a delay important to somebody making a decision with this information? And if the answer is yes, then it is significant and you should apply time value of money. Now, I will say, if the delay is more than 1 year, there is no choice. Under US GAAP, by definition, a delay of a year or more is significant, and so therefore you must apply the time value of money. If the delay is less than a year, there is judgment. If it's material, we should apply the time value of money. If it's immaterial, then we don't. So imagine that you just bill somebody with a payment in 30 days. That's fairly normal. No one's going to really care that there's a 30-day delay in payment. But let's say there's a 8-month delay in payment. Maybe that's material. Maybe it's not. And so that gets a little more fuzzy. But once you hit that 1 year mark, US GAAP basically says there's no more judgment. You must apply the time value of money. The second thing, the firm must use the most clearly determinable, i.e. the most reliable, imputed interest rate. All right. So what does that mean? So in other words, they have to use the most reliable imputed interest rate. So time value of money doesn't have to apply within 1 year. It doesn't have to. It can, it just doesn't have to. All right. Now, I will say for the purpose of any test that I give, if it's less than a year, you don't have to use time value of money. If it's more than a year, then you do. But all that in the second step then is, okay, well, given that I'm going to use the time value of money, I need a discount rate. And so we have to figure out what is the most reliable way to arrive at a discount rate. So in practice, the firm usually has to compare the reliability of the sales price of the good or service to an inferred discount rate on similar debt. So in other words, they have to ask themselves, if we were to receive cash payment today for this item, what would we charge? That would be one way to get to a reliable present value. And then on the other part of it, then they'd have to say, okay, well, the other choice would be to say, okay, well, I borrow money every day, or I lend money every day, or people out in the market borrow and lend money every day. What is a fair interest rate in the market? So hopefully you see that the interest rate in the market probably is going to be a level 2. Unfortunately, at the same time, the good or service, depending on what it is, it could be a level 1, it could be a level 2, it could be a level 3. And so probably more so than anything you've done, whenever you're talking about which one is more reliable, it's not very clear. Now I will say, for the purpose of any test that I give, I'm going to make it clear. But in practice, I want you to be aware, with these delayed payments, it is oftentimes very unclear about the best way to calculate the present value and to get an interest rate. And so there's significant judgment when applying this standard. Just document what you're doing. All right, let's do an example. A manufacturer sells a custom-made piece of machinery on February 1st, 2020. The company agrees to accept payment of $400,000 on August 1st, 2021. Hopefully you see this is more than a year. Since it's more than a year, we must use the time value of money. So the manufacturer's internal borrowing rate is 6%. While there are no comparable equipment sales, the manufacturer estimates that the market value of the machinery is $350,000. Record all journal entries related to the sale. All right, so first of all, the delay in payment is significant. That we know. Second of all, which present value is more reliable, the estimated market value or the firm's internal borrowing rate? And the answer is, I haven't told you. So what we're going to do, rather than me saying let's just do one, we're going to kind of walk through and sort of solve it one way and then solve it the other way. And we'll kind of go from there, kind of figure out what we learned from this exercise. And so if we conclude that the market value of the good or service, in this case the piece of equipment, if we believe that the piece of equipment is more reliable than the internal borrowing rate, then we would use that first row. If we believe that the internal borrowing rate is more reliable, then we would use the second row. But in either case, we need to apply the time value of money. What we can see is that the N, the payment, and the FV are unchanged because those are terms in the contract. You're going to receive $400,000 1.5 years from today. All right, so those pieces are fixed no matter how we do the TVM. Those three components remain constant. And so what we're determining is, can I more reliably estimate the I/Y, or can I more reliably estimate the PV? And then I'll use the information that I have to solve for the other. And so I want you on your own to try to get the I/Y in the first row and try to get the PV in the second row using your time value of money calculator. Or if you have some other method, of course, you can use that. But I'd say start getting used to your calculator. Sorry, I need caffeine. Anybody have an answer for either? All right, do we have a number yet? I'm not seeing anybody put anything in the stream. So, all right. So Harry has 366,521 for the PV. Thomas has 9.31% on the I/Y. Nirmal Kumar has 9.31% as well. Shane 9.31. And the answers are there, so we're just going to kind of reveal. So yes, so if we solve for the I/Y, we get 9.31%. Good. And if we solve for the internal rate, or use the internal rate to solve, then we get the present value of 366,523. And so the answer is, depending on which one we think is more reliable, both of these answers could be correct. Both of these answers potentially would be acceptable under US GAAP. All right, so this is the concept of what's going on. Now for me, this is a key concept or a key way to think about this whole transaction. So the idea here is we're going to receive $400,000 in remuneration. So the total revenue related to this transaction is $400,000. And we're just trying to figure out, okay, well, how much of this are we going to allocate to sales revenue? And how much of this are we going to allocate to interest revenue? And so you can see that sales revenue is whatever the present value is, and the interest revenue is whatever's left over. So in other words, we're taking that $400,000 and we're breaking it up into two pieces. And the method for doing that, it just depends on what you think is more reliable to get there. So in the first case, we said, well, the fair value of the piece of equipment is more reliable. So we're going to allocate $350,000 to sales revenue, which means then our interest revenue for this transaction must be exactly $50,000. In the second case, we decided that the 6% discount rate was the most reliable, and in that case, we would allocate $366,523 to sales revenue and then $33,477 to interest revenue. Now, on its face, this might not matter, but it actually kind of does. And the reason why is, number one, sales revenue is going to be a top line item on the income statement. All right, so that's the top line, and I get to immediately recognize that sales revenue. So it's higher in the income statement, which most users believe is sort of more persistent. So there's more value associated with it. So a higher value, and I get to recognize it sooner. And so that's kind of preferred. Whereas the interest revenue, I get to recognize that sort of as time passes, but I certainly don't get to recognize it immediately. And typically interest revenue shows up down below in non-operating items. And so it's going to be perceived as less persistent or less central to what the company does. And so you have this trade-off of, do I want the top line item now, or do I want a bottom line item later? And so the idea is typically companies prefer a method that accelerates the sales revenue, that has a higher sales revenue amount. And so if they truly were indifferent, my guess would be that they would use the second situation because that maximizes sales revenue. I'm not saying that's necessarily the right way to do it, but I'm just saying that's typically what companies are going to favor because it allows them to report the highest amount of sales revenue. Again, that's an aggressive approach, but it is an acceptable approach under US GAAP. But no matter what, we have to take that $400,000 and we have to break it up into its two components, and we have to find a reliable method for doing so. And we've illustrated two of them here. Okay, so it's likely that the internal borrowing rate is going to be more reliable, so we're just going to kind of move through our journal entries using that. So basically, higher sales revenue is more preferable. Yes. Yes, Aiden, absolutely true. The higher sales revenue is preferable, again, because it's a top-line item, and because I get to recognize it immediately. Now, as an accountant, we don't have a preference. So from a truly strict accounting perspective, we don't have a preference. We just want what's true. We want the most reliable. Okay? However, a CEO or a CFO is strongly going to prefer more sales revenue. So just understand there's going to be some tension there potentially. But in this case, we're just going to say that the borrowing rate is more reliable, and so we're going to move forward with that. So given that the borrowing rate is more reliable, we know that we have this note receivable or this account receivable, and it's going to be carried at its face value of $400,000. We already said on the previous slide, we're looking at the bottom one, we're saying that we're going to allocate $366,523 to sales revenue and any amount above that to the interest revenue. Notice though in the journal entry, the sales revenue number is right there, but notice that the second piece of the journal entry is the discount on the note receivable. It's not interest revenue. It's not even unearned interest revenue. It's nothing like that. The idea here, if you remember all the way back to chapter 14, we talked about interest expense being a function of two things. We said it's a function of the interest payment plus the discount. And so what we're kind of doing is we're kind of piggybacking on that same concept where the interest revenue is going to be captured by the discount on the note receivable or the discount on the accounts receivable. And so the whole idea here again is that this $33,477, that's the interest revenue that we're going to record over time. But we have not yet earned any of it because no time has passed. And so basically what we're going to do is we're going to amortize that discount. And as we amortize that discount, we're going to recognize the interest revenue. All right. Now again, technically speaking, the amortization is an ongoing process, but we're going to record things periodically. And so we're going to kind of walk through how to do that. So the first thing that is going to occur is we're going to come to our fiscal year end. So this is like this is like a zero interest bond. Yep, Harry, exactly. Yep. Although I will say with the zero interest bearing bond, I think depending on, no, we use TVM. Yeah, so as long as we use TVM, it's all the same. Yep. All right, so again, so now we come to our fiscal year end. So really nothing happens really immediately. Nothing economically happens until we pay this this note or receive payment for the note. However, we have a fiscal year end, and at that fiscal year end, we need to recognize the fact that we've been earning interest revenue over the last 11 months. And so the way that we calculate that is we take that initial carrying value of $366,523, and that's the present value. We apply the discount rate of 6%, and then we accrue that interest for 11/12. And the reason why is because, of course, we signed this on February 1st, and so between February 1st and December 31st, it's 11 months. And so we recognize 11/12 of that interest revenue for a total of $20,159. And so therefore our journal entry is an amortization of that discount, which is the debit, and a credit to our interest revenue. Now I will say some students will be tempted. So you're going to kind of come now 1 month later, you're at the end of January. And of course now we're at 12 months. The company actually doesn't make any entry on that date because really nothing happened. Now, we continue to accrue, we continue to use time value of money. We don't record anything until either the note is paid or until the fiscal year end. And so in this case, whenever we come to the 1 year mark, the January 31st, 2021, there's no journal entry. The next journal entry really is not until the note is collected. So I just want to be clear that the reason why we're doing this journal entry at 11/12 is because it's a fiscal year end. That's why we're doing this journal entry. So then our final entry records the payment as well as recording any remaining interest revenue. And so the remaining interest revenue, again, we take that initial balance of $33,477. We subtract what we had already recorded, the $20,159, which means that whenever this final payment is made, we have an additional amount of interest revenue to record, which is where we get the $13,318. Actually, that math does not seem to, $13,318. So then that journal entry is we amortize the discount, we record the interest revenue, and of course we get the cash payment of $400,000. So again, we're recording the last, 7 months. 7 months of interest revenue. Okay. Hopefully that wasn't too hard to follow. So non-cash consideration. So when goods and services are exchanged, that means there's no cash that's part of the transaction. So generally speaking, the firm recognizes revenues in terms of the fair value of the asset or service received. And so if let's say that I'm a computer software company and I'm going to maintain somebody's software. Let's try to think like an accounting company's software. In exchange, they're going to give me accounting services. So in other words, I'll maintain their software. They give me some accounting advice. So there's an exchange of services. If I'm the software company, I'm going to estimate the fair value of that accounting service, and that's what I'm going to recognize as revenue. The accounting service would basically estimate the fair value of the computer service, and that's what they would use to value the transaction. And so just understand, whenever there's this exchange, generally speaking, you use the fair value of the item that you're receiving to estimate the fair value of the transaction. If that amount is not determinable, then you can use the revenue, you can use the fair value of what you provided. So in other words, if you have no idea really what that fair value is, which doesn't make a lot of sense, but let's say that you just don't have a reliable way to estimate it, but you obviously know the fair value of what good or service you're providing, then you can use your own, the fair value of the good or service that you provide. Again, a lot of this is in your notes already, so I don't want to spend too much time. But just wanted to highlight that. Another part of this third step of figuring out the transaction price is the consideration that's paid or payable to customers. So this is usually whenever you've done accounts receivable and there's a discount, like if they pay fast, if like the I forget what they call it, but they give you like a 5% discount if you pay cash within 30 days or something like that. This is kind of what this is getting at. So if there's a discount. Now this is kind of a key, which probably wasn't discussed. Maybe it was discussed when you went over accounts receivable, but this is what the standard kind of highlights. The firm should consider the likelihood that the discount would be taken. So in other words, how likely is it that the customer is going to pay in a way that where they're going to receive the discount? If it is likely, then the firm should only recognize the net receivable as revenue, not the gross amount. However, I want to note most firms will recognize the gross amount. So typically what you're going to see on an income statement is sales revenue less sales discounts and returns and all that kind of stuff for a net amount. So companies most often give you the gross number and then subtract off the discount. Under the US GAAP, what they're saying is if it's very likely that the discount is going to be taken, you should just in that top line, at the very top line, only recognize the net amount. That's the guidance under US GAAP. Although, again, there is flexibility in how it's applied. All right, step 4. So step 3, we've kind of completed here. Now we're on to step 4, allocating the transaction price. So we've now figured out what the transaction price is. Now we need to allocate it. So allocating the transaction price can be a challenge when there are multiple performance obligations or deliverables. US GAAP strongly urges firms to develop standalone sales prices for each performance obligation. That is their strong preference. They want it written in the contract. However, some sales arrangements might not have the ability, or companies might not be willing to provide standalone pricing. There could be competitive reasons. There's a number of reasons. And so in those situations, we do have a bit of a challenge. Okay, so when a firm does not have standalone prices, there are 3 alternatives. One is the adjusted market assessment approach. So with this one, the firm proportionally allocates the sale price based on the relative market value of each component. So this is a situation where I have a reliable fair value or a reliable market value for each component in the contract, for each single performance obligation, each good, each service, each whatever. In other words, I can reliably estimate every single item. If I can do that, then I need to use the adjusted market assessment approach, and I need to use some sort of proportionality to allocate it. We're going to illustrate how to do that, but we're going to proportionally allocate the sales price. A second method is called the expected cost plus a margin approach. So the firms forecast the cost to satisfy each performance obligation and then add a margin to that good or service. So in this situation, it's not necessarily that I can reliably estimate the fair value or market value, but instead I can actually forecast the cost. So if I can forecast the cost, so let's say that my total costs are $100,000 for satisfying this contract, and the contract calls for $150,000 payment. Well, my margin is 50%. And so what we do then is we figure out what's the cost of each performance obligation and then add a 50% margin to each of those items. Again, we're going to go through how this works, but this is a situation where maybe the market value of the items cannot be reliably estimated, but cost can be reasonably estimated. And so then the expected cost plus a margin approach is the most appropriate. And then finally, there is a third approach called the residual approach. And so this is a situation where a firm can reliably price some, but not all. And so what they do is you figure out which ones you can reliably estimate, and then allocate any amount beyond that to the unpriced items. So let's say that I have 3 performance obligations, and I can reliably estimate 2 of them. Well, I assign those amounts, and then the residual amount gets assigned to the third. Again, we're going to illustrate this, but I want you to understand that these all 3 are acceptable approaches under the new guidance for revenue recognition. However, they may not all be equally preferred in every situation. So you have to think about, what situation am I in and which approach is most appropriate in that situation. Let's kind of walk through an example problem so you can see how these things work. So 49er Company sells a piece of equipment for $450,000 on January 1st. The sale includes 1 year of seller-provided maintenance service. The firm estimates that the market value of the equipment absent the service is $438,000, and the market value of the service absent the equipment is $30,000. The cost of the equipment is $355,000, and the cost of service is $20,000. Provide journal entries, assuming we're going to go through some different scenarios. The market price of the service is significantly more reliable than the market price of the equipment. In the second situation, the market price for the service and equipment are equally reliable. And in the third situation is neither price is reliable, and instead the firm uses the cost plus margin approach. So we're going to go through each of the 3 scenarios. Again, we have $450,000 of revenue. We're trying to figure out how much do I allocate to the equipment and how much do I allocate to the service. It doesn't change the total, it just changes how I allocate it. So if the market price of the service is significantly more reliable, then 49er Company should use which approach? So in the chat, please give me which approach 49er Company should use in this situation. So Harry says residual. Nirmal Kumar says residual. You're both right. So we'd use the residual approach. Good, good, good. All right, so we allocate the sales price of $450,000 to each obligation. The service would be $30,000, and the equipment would be $420,000. Again, because the idea here is the service is more reliable, so I assign the fair value or the market value of the service to service, and any remaining amount, the residual, to the equipment. And so we'd record it this way. So then let's walk through the journal entry. So again, the cash that we're receiving is $450,000, and then we allocate sales revenue $420,000, and then the unearned maintenance revenue of $30,000. Now notice in this case, because I've received the cash, the maintenance then becomes unearned revenue. So it's a liability, and then as I perform the service or as time passes, I can start recording the maintenance revenue associated with this sale. But again, the sales revenue is immediate. Okay, and then again, as time passes over that year, the unearned maintenance revenue goes away, and we record the maintenance revenue of $30,000. Go back one slide. Is this the one you meant, Aiden? All right, let me know when you're caught up, and I'll move forward. All right. All right, so there are journal entries. The cash, of course, is allocated, and then we recognize sales revenue immediately and recognize maintenance revenue as time passes. So now if the market price of the service and equipment are similarly reliable, then what approach should be used? So again, in the chat or out loud on your own, what approach should we use in this case? AMA, I like it. Yes, being efficient, Harry. Well done. And that is correct. The adjusted market approach. And so similarly then, we allocate the sales price to each obligation. This one's a little more complicated though. So we have to figure out the fair value of the two items together, or the market value of the two items together. And we can see that together their fair value is $468,000. Then from there, we're going to allocate to the service, and we're going to use that to the proportion of the fair value of the service to the overall fair value. That's where we get the 30,000 over 468,000. It's the proportion of the fair value of the service to the overall fair value of both items together. And then of course what we are allocating is the 450,000. So we take that proportion and we apply it to 450,000, and that gives us the amount that we need to allocate to service, which is $28,846. And then we similarly make an allocation to the equipment. Again, the proportion of the equipment fair value compared to the overall fair value, and then we apply that proportion to the sales price to get the amount of revenue that we're going to assign to the equipment, $421,154. Again, this one's a little more complicated than the residual approach because we have to calculate the overall fair value of both items together, and then we have to use their proportions applied to the sales price in order to get the amount that we allocate. But the method is the same. So as soon as you figure out how to do it, it's just sort of that same rhythm over and over again. I'm going a little slower because I know last time Ada needed me to go back, and so I'm just going to assume that everyone's probably taking a little more time to write this down. So that's why I'm moving slower. Okay. So the journal entries. Again, same accounts, different amounts. The cash that we receive, of course, is the same. But now, of course, we're allocating $421,154 to sales revenue and $28,846 to unearned maintenance revenue. And of course, then that unearned maintenance revenue is going to be earned as time passes. And so by December 31st, 2020, we would have recorded the maintenance revenue of $28,846. Again, both of these would be acceptable depending on what the company concludes regarding the fair value of each item. All right, now the final one. If neither the price of the service or equipment are reliable, and then they should use which approach, and hopefully by now this one's obvious that we're left with the cost plus margin approach, and in fact I explicitly said on the previous slide that this is what they're going to use. So again, this is a little more complicated than the residual approach. We kind of have to walk through and say, okay, what's the total estimated cost of both items together? So the total estimated cost is $375,000. So that means the margin is 1.2, because if we take 450,000 and we divide it by the cost of $375,000, that gives us a ratio of 1.2. So that's the margin. So in other words, we're getting 20% above cost overall on this contract. And so what we're going to allocate to the service is we're going to take that margin and apply it to the cost of the service. And we're going to do the same with the equipment. We take the cost of the equipment and apply the margin to the equipment. And so you can see from this, we allocate to the service $24,000 and we allocate to the equipment $426,000. Again, this is the cost plus margin approach. So you calculate the total estimated cost, figure out the margin, and then apply that margin to each item, the service and the equipment. Of course, if there were more than one, you'd have to continue to apply that margin to the additional items as well. Okay, so the journal entries, same accounts, different amounts. So the sales revenue is $426, the unearned maintenance revenue is $24, and of course then over time we earn the maintenance revenue, and by the end of the year we have earned all $24,000. I'm hoping by now when you get to the journal entries, that's not the hard part. The hard part is to figure out the best way to do the allocation. Again, it all depends on the information that you have. On a test, I'll make it clear which approach that you should use. I'm not going to make you guess or anything like that, but I just want you to be aware that all three are acceptable under US GAAP. Okay? All right. Step 5, recognize the revenue. So step 4, we've just finished up. Step 5, recognize the revenue. This one's just conceptual, so there's not a whole lot going on here in terms of calculation. But the key idea is that the seller recognizes revenue when control of the good or service transfers to the buyer. So when control transfers to the buyer, that's when the seller is going to recognize revenue. This is just the general idea. When control transfers, that's when they recognize revenue. So in many cases, the transfer of control is obvious. Obviously, it's especially true when you have a good. So some examples. So when a car dealership signs the title of a car over to the buyer, when that happens, now control has been transferred to the buyer. If a customer finalizes the purchase of a clothing item at a retail store, like you walk out of the store with the sweater or the jeans or whatever, well, guess what? The customer now controls that item, and so we can recognize revenue. However, sometimes a service is a little bit harder to think about. So example, when a sports team plays the game, control of watching the game transfers to the customer, sort of going back to our prior example. So when they play the game, whether or not the customer watches the game is completely within their control. Up until that point, it was not. And so again, this is kind of thinking about when control transfers. So when a lawn care company completes cutting the grass of a customer, the control of subsequent lawn care decisions lie with that customer. So in other words, we've done our part. Now the control is back in the customer's hands. And so then they get to recognize revenue at that point in time. Again, these are just examples, just some ideas on how to think about it. This isn't, obviously every example we can talk about, but it's just trying to get you to think about that transfer of control, transfer of control, transfer of control. So there are some general indicators that a transfer of control has taken place. Let's kind of walk through those. If the company has a right to payment for the asset, then it's an indication that the transfer of control has taken place. Another one is that legal title has been transferred. Another one that physical possession has been transferred. Another one is that the customer has risk and rewards associated with ownership. The customer has accepted the asset. What's really important to note is these 5 things are indicators. They are not rules. And so it's not to say you have to check all 5 boxes in order to recognize revenue. It's just to say that if these things are true, whether one or all, then it's an indication that transfer of control has taken place and you should be able to recognize revenue. Again, these are indicators, they are not rules. But these are things to think about. If you're wondering, can we recognize revenue? Just kind of run through this list of 5 things, and that gives you an indication on whether or not you can recognize revenue. But of course, there is still judgment on any one of these items. Sometimes, not always, but sometimes. All right, so now we're going to go through some more like specific, I would say specific issues. So those are the 5 steps. Now we're going to go through some more specific issues, some things to think about within the context of revenue recognition. So right of return. So many times a firm makes a sale and it includes a right of return related to the product. So it could be a credit, exchange, refund. So in other words, you might have a 30-day money-back guarantee. You might have other things, but somebody has the right to return the good to you. And so how do you handle that? The key in this section is the firm may need to make an adjusting entry to reflect their expectations. So in other words, you still recognize the sale, but you may need to make an adjusting entry at the end of a fiscal period or whatever it might be in order to include the possibility or the probability that some items are going to be returned. So your sales revenue is still there initially. It's just a matter of, well, you may need to make an adjusting entry after the fact based on your expectations. So again, the net sales and the reported cost of goods sold should reflect what the firm expects to receive after all returns have been made. Again, you make the initial sale, that doesn't change, but subsequently you probably need to make an adjusting entry like with the sales return and allowance and all that kind of stuff based on your expectation. It doesn't change your sales amount, but it would change your net sales amount. So it's important to note this is an adjusting entry related to current year's sales, but where the return still has not yet occurred. So in other words, you still have these goods out there and rights are still out there, and you've got to figure out how much of this do I expect to be returned, and that's going to sort of create the need for an adjusting entry. So let's walk through an example. So 49er Company sells 50,000 products during 2020. Clients are charged $10 per product and their cost is $6. They estimate that 4% of the products are going to be returned. By the end of 2020, 1,135 products have already been returned and they were issued a full refund. So now let's provide any necessary adjusting entries for 49er Company on December 31st, 2020, assuming that all sales are cash sales. All right, so the total expected returns for the 2020 sales is 2,000 units. So the expected future returns are 865. Given that 1,135 have already been returned, they expect another 865 to be returned. So now we're at the end of 2020, and we have an expectation that there's going to be a return of another 865 units. So how do we handle that? We need to make an adjusting entry based on that right of return. So we have to make an adjustment. So the sales return, so we believe there's going to be $10 per unit, and we believe there's going to be 865 units that are going to be returned for a total of $8,650. And of course, with cost of goods sold, rather than using the unit price, we use the unit cost of $6 per unit. So we believe there's going to be the need to adjust our cost of goods sold for $5,190. So again, this is December 31st. We're trying to figure out what adjusting entry we need to make based on this right of return. So with the sales returns and allowances, we're going to debit that account. It's a contra equity account. We're going to debit that account $8,650. And then we're going to have this accounts payable account sitting out there, $8,650, because the idea is we believe we're going to have to make these payments either in terms of a replacement or a cash refund to our customers. And so we're going to account for that with this account payable based on our future estimated sales returns and allowances. Similarly, on the cost of goods sold number, you have the credit to cost of goods sold. Again, we're reducing cost of goods sold based on that return, because whenever an item is returned, you have the sales return and allowance, but then you have to get rid of the cost of goods sold associated with that item. And so we're calculating the amount of that cost of goods sold credit. And so in this case, because the inventory hasn't actually been returned, we create a new account called estimated inventory returns, and that is an asset. And so the $5,190. And so this would be the adjusting entries that we would need to make on December 31st, 2020 for what we expect to be returned in 2021 for sales that we made in 2020. Again, this is all based on expectations. The allowance for doubtful accounts. So Harry, the allowance for doubtful accounts is if a customer isn't going to pay. So that's a situation where I make a sale on credit, and so I have an accounts receivable, and I'm trying to estimate the number of people that actually aren't going to pay me. This is a little bit different because this is a return. This isn't somebody not paying me. Actually, they've already paid me. It's been a cash sale. This is a situation where they actually just returned the item altogether. Okay. Repurchase agreements. So a repurchase agreement is an arrangement where the seller agrees to a repurchase price that is equal to or greater than the original sales price. The seller is often obligated to repurchase the good at a future date. Sometimes there can be a buyer option. In that case, if the buyer has significant economic incentive to exercise the option, you may also fall into what's called a repurchase agreement. So again, a repurchase agreement must be the seller agrees to a repurchase price that is equal to or greater than the original sales price. So it's sort of like I'm selling you this item now, but I'm promising you to buy it back for more money later. So it's kind of a weird situation. And then the second piece of that is that the seller is often obligated to repurchase the good at a future date. In other words, sometimes that obligation is one that I have to do it. It's not my option, I actually have to do it. And what we're saying is, so those two things would qualify as a repurchase agreement. That second step, if the buyer has an option where they have a significant incentive to force me to repurchase it, that it may also qualify as a repurchase agreement. Is it the same as a sale leaseback? No. And the reason why it's not exactly the same as a sale leaseback is because in a sale leaseback, the seller is not actually repurchasing the item. They're leasing it back. So it is a little bit different. So it's not the same as a sale leaseback. Now, if you have a repurchase agreement, the seller should not recognize revenue related to sales with a repurchase agreement. In other words, they cannot recognize revenue with a repurchase agreement because you haven't really made the sale. It's just round tripping. This is something that actually used to happen a lot of times. Like banks would actually, so let's say that I'm a pharmaceutical company and I need to hit a sales number at the end of the quarter. Well, these pharmaceutical companies would have arrangements with banks where they would say, okay, I'm going to sell you all my pharmaceuticals for $100 million or whatever the number is that they needed to sell. And then I'll buy them back from you at $101 million on January 15th. And so this was basically a way that the pharmaceutical company would record the $100 million in sales, and the bank would do it because, well, I'm going to get an extra $1 million just by holding these for, 15 days or whatever it might be. And so this was under the new revenue recognition standard. They're like, no, you can't do that anymore. It has to be a legitimate third party, sort of a arm's length transaction. Bill and hold arrangements. So normally a seller cannot recognize revenue until control of the good or service transfers to the buyer. And we talked about all those indicators that control has transferred. However, there are certain bill and hold arrangements that may allow the seller to recognize revenue before the buyer has taken physical possession of the good or service. So this is an exception, basically saying normally you have to wait to recognize revenue, but in certain bill and hold arrangements, we may allow you to recognize revenue before transfer of control has taken place. So there's 4 criteria. First of all, the reason for the bill and hold arrangement must be substantive, and we'll talk about what that means in a second. So basically, there has to be either like physical space issues or reasons that the buyer can't take possession yet. They can't just channel stuff. It's very specific that channel stuffing is not legal. The product must be identified separately as belonging to the buyer. The product must be currently ready for physical transfer to the buyer, and the seller cannot have the ability to use the product or direct it to another customer. So, a classic example of this that makes sense to me at least is a lumber yard sales to a construction company. So, if you go through South Carolina for any length of time, you're going to come across a very large lumber yard at some point because that's just one of the biggest industries in South Carolina. Well, a lot of times what happens in a lumber yard is they get the lumber, they cut it up, and a lot of times like a construction company might be buying the lumber from the yard, but they can't take possession of it. So imagine that a construction company is trying to build a house, and they've ordered the lumber from the lumber yard, but let's say that the site hasn't been prepared yet. In other words, the foundation hasn't been poured yet, or for whatever reason, there's a weather delay, whatever reason, they've got nowhere to store that lumber. And so what they can do with the lumber yard is say, hey, can you hold on to our lumber for us until we can take delivery? And if the lumber yard is able to meet these 4 criteria, then they could actually recognize the revenue with that sale, even though the construction company hasn't taken possession. Actually, this is a very common practice. And so what the lumber yard will typically do is they'll package the lumber, they'll put it on pallets, whatever they need to do, and then there are usually large stalls on the lumberyard facility where they can designate the stall as belonging to XYZ construction company and say put all the stuff there so that when the construction company is ready for delivery they just have to swing by and pick it up. And so that's just kind of the classic example of a situation where they can actually record the revenue using this bill and hold arrangement. But again, if you can't meet these 4 criteria, then you have to wait to recognize the revenue until the buyer takes possession of the good. Principal-agent relationships. So oftentimes firms are going to use third parties or middlemen to facilitate certain sales transactions. And so the question that you have to ask yourself whenever there's a third party involved, you have to ask yourself, okay, when's the transfer of risks and benefits related to the good or service? In other words, who's taking risk and who's not taking risk? Who's getting what benefits? Who's not getting certain benefits? And so you have to kind of think about what's happening with the item when there's a third party and saying, okay, where are the risks? Where are the benefits? Who's obligated to do what? And so you got to think about that whenever you have revenue recognition issues. And we're going to walk through an example that I think is going to help illustrate that, but that's what you got to think about is who has what obligations, who has what risks, who has what benefits. So what is the principal responsible for? What is the agent responsible for? And when does each fulfill that responsibility? Those are the key questions when you talk about principal-agent relationships and recognizing revenue. So let's talk an example here. I book a room at the Biltmore Hotel through Expedia for $250, and I do so on October 15th. Expedia collects $10 for arranging the reservation and remits the remaining $240 to the Biltmore for the stay on November 20th and November 21st. How much revenue should the Biltmore Hotel and Expedia recognize, and when should they recognize it? Okay, it's very important to note, Expedia never accepts responsibility for the reserved room. In other words, if something happens and this reservation falls through, it's on the Biltmore Hotel to help the person out, not Expedia. The Biltmore is the one responsible for providing the room, not Expedia. All right, so Expedia never takes responsibility for the reserved room. So that means that Expedia can only recognize their $10 fee because their responsibility is for the reservation. And so the performance obligation is only the reservation. And so the value of that reservation is $10. And so that's what they can recognize as revenue. But the nice thing is the reservation is finalized on October 15th. So they can recognize revenue on October 15th. The Biltmore has the responsibility to provide the room to the customer. They have that responsibility. And so the Biltmore can recognize the $250 in revenue. In other words, the total value of that room is $250. That's how much a customer was willing to pay. So the value of the room is $250. But they also, obviously, because they used Expedia to book the room, they have to pay. They have a $10 cost of goods sold, but they have to wait until November 20th, 21st in order to recognize it. In other words, they can't do so on October 15th because their obligation is to provide the room, and they don't provide the room until November 20th and 21st. Now, as far as whether they recognize it on the 20th or on the 21st, I'm not really worried about that, but just somewhere across those 2 days, that's when the Biltmore Hotel is going to recognize the revenue for that room. Again, this is a principal-agent relationship. Both the principal and the agent get to recognize revenue, but the amount and timing are different between the two. Consignments. Consignment is basically a situation where I'm selling a good. I go to a person and say, hey, I'm gonna sort of transfer the good or service over to your physical space, and then you're going to sell it for me. That's what a consignment is. A third-party retailer, like a call center, is the agent for DirecTV. If they're the sales center, yes. So so call center for like service, then I would say no. If you're talking about calling somebody and buying DirecTV from a third party, then yes, exactly. They would be the agent, and DirecTV would be the principal. And so the agent probably gets some sort of take on that sale, and that whatever that commission is, that's what they get to recognize, and they get to recognize it as soon as the customer signs on. Whereas DirecTV has to wait until they start providing the TV service in order to recognize revenue. So yes, Harry, exactly. Very, very similar situation. So since this consignee does not take legal possession of the good or service, it cannot recognize revenue for the full retail price amount. The consignee can only recognize revenue for its sales fee. As an example, if they sell a $100 piece of furniture and charge a 10% fee, the consignee can only record $10 in revenue, kind of like the agent in the situation we just highlighted before. Warranties. So current liabilities, we talked about assurance type warranties, which kind of protect against defect, and that's kind of warranty expenses. In the context of revenue recognition, they're really focused more on service type warranties. And so this covers defects, but also breakage, and it's really designed as an additional way to get revenue. And so in other words, like if you ever have purchased virtually any electronic item, usually they offer you a protection, right? So you can buy your iPhone, and then they'll say, oh, for another $100 or $150, we can offer you a protection warranty. And so what they'll do is that is a service type warranty, and that would be recognized separately from the sale. Whereas an assurance type warranty might be a situation where if it's just defective, they'll give you a new one. And those are just different types of warranties. And so with service type warranties, it really should be separately priced and recognized, independent from the sale. Non-refundable upfront fees. Again, what I'm doing here is I'm just kind of going through all the different nuances discussed in the books, and so we're just kind of walking through each one. So I know it gets a little bit tedious, but you can review these, because on the test we're just going to be there's going to be questions on all this stuff, and so that's what we're kind of navigating right now. So the key with any non-refundable fee is that the fee is inherent to the good or service that's being reserved. So in other words, the buyer is paying the fee in order to receive a good or service, and that's really what the performance obligation from the seller is. And so with any of these non-refundable fees, the seller cannot recognize the revenue until it has actually performed under the contract, or until the buyer forgoes his or her right to the obligation. So in other words, the idea here is that while there might be a non-refundable fee, I can't recognize the revenue for that fee until I actually perform on the contract. And so a lot of times students get confused by that. So let's walk through an example. So with a NASCAR experience, actually we're getting ready to buy one of these for my 14-year-old son. He's going to do an IndyCar experience. And anyways, what they do is you make a reservation, you pay a fee, a non-refundable fee, so if you miss your slot, they keep that fee. Let's say the total experience is $150. Well, let's say the upfront fee, the non-refundable fee is $50. Well, what happens? Why am I paying the $50 upfront fee? Well, I'm paying the $50 upfront fee so that my son can drive around a racetrack in an IndyCar, right? And so when you talk about that, $50 fee, they cannot recognize it until one of two things happens. Either my son does the experience, or I cancel and I forego my right to the experience. At that time, either of those two times, that's when they could recognize the upfront fee. A catering service, a lot of times, they're going to want 10 or 50% down. Same idea, right? If I pay an upfront fee or a non-refundable fee to reserve a caterer, the reason I'm doing so is because I want them to cater my party. And so they can't recognize revenue until they actually cater my party. Or if I were to cancel the party, at that point in time, if I've foregone my right to the catering service, at that point in time, they could record the revenue. Kind of one of the last things here, contract assets and liabilities. It's a foundational concept we need to talk about. Revenues and expenses are derived from changes in assets and liabilities, and this is really important in the context of contract assets and liabilities. So US GAAP's treatment of contract assets and liabilities has important implications for revenue recognition. So a contract asset and contract liability are not prescribed by US GAAP, but they are names that are commonly used. And so I want you to understand we're using these terms, contract asset, contract liability, because the book uses them and they are common, but US GAAP does not prescribe that these are the only names that can be used when we're talking about this concept. All right, so treatment of contract-related assets depends on whether the seller has a conditional or unconditional right. So this whole context is we're starting to work and some things start happening. So there's activity. And so we're creating contract assets. We're creating contract liabilities. How do we handle them when we're sort of partially through a process? And so the whole idea here is, well, it really depends on do I, as a seller or the provider of that service, do I have a conditional or do I have an unconditional right? If the firm has an unconditional right to consideration, in other words, there's nothing left for me to do, you need to pay me, this is how much you owe me, all right? Usually it's going to be cash. Then the seller records the value of the consideration as a receivable. This is the classic accounts receivable. So as soon as you have an unconditional right, that's an accounts receivable. If you have a conditional right, in other words, some of the performance has been met, but not all of it, then you may have a contract asset if you have a conditional right, meaning that you have a right, but there's still some things that need to be done. You may have what's called a contract asset. And so typically with the contract asset, now we're kind of getting into more of these long-term contracts where there's multiple, like a performance obligation could be, a year or a year and a half long. And so in that kind of situation, these contract assets become very, very important because it allows someone to record revenue even when all of the performance obligation has not yet been completed. So contract liability is another name for unearned revenue, and that's when a seller receives payment but must provide a contractually obligated good or service at a future date. Contract modifications. A contract change can be treated either as a new contract or a modification of an existing contract. And so the question is, well, when is it a new contract? So if the good or service is distinct from the prior contract, then it could be treated as a new contract. The second thing is the company must have a right to standalone consideration for the promised good or service. And so again, that standalone consideration, that sort of two things together means that you do have a new contract. So in that case, the new contract would be treated as a separate performance obligation. If the good or service is not distinct, or if there is not standalone consideration, then it is a modification of an existing contract. And that's what's called a prospective modification under the new guidance. Key though, whether it is a new contract or a modification of an existing contract, it does not change the same, it does not change the total amount of revenue, but it absolutely could change the timing. So just be aware of that. So it doesn't change the amount, but it could change the timing. So as an example, a company signs a one-year contract to deliver 1,000 units at $10 per unit. By July 1st, 49er has delivered 800, but the client would like an additional 1,000 units. The client would like a discount since the order is larger. So how do we handle this? If 49er can distinguish the additional units from the previous order, and if 49er offers the client standalone pricing, then the change would be a separate performance obligation and would be treated as a new contract. So if 49 agrees to a $9 per unit price for any unit sold over 1,000, then 49 would recognize $10 per unit for the remaining 200, right? For the first 200. So basically, we're saying, okay, now we've hit our 1,000, and then the amount above that, the additional 1,000 units would be priced at 9. So that'd be $9,000 then for the remaining 1,000 units. But if 49er does not distinguish or does not offer standalone pricing, then the change would be treated as a contract modification. So how would that look differently? Well, 49er agrees the 1,200 remaining units, they just kind of have a price. They say, okay, well, for the remaining 1,200 units, we're just going to have a new price of 11,000. So basically, we throw away the old price and give you a new price, 11,000. So how do we handle that? So now you take that 11,000, you divide it by the 1,200 units, and now there's a new price per unit of $9.17. So again, $9.17 per unit, and that would be applied. So versus 2,000 to 9,000, it would just be $9.17 for each unit without distinguishing between the two. Again, these are just example after example after example of unique situations that the book walks through, so we're going to kind of walk through them as well. Costs to fulfill a contract. Costs can be capitalized or expensed. US GAAP favors expensing costs as they are incurred. In order to capitalize a cost, it must be direct, incremental, and recoverable. And so one example I always think about is whenever you have, let's say, a fleet of trucks, and I'm wondering, okay, I have costs to maintain those trucks. Well, can I capitalize those, in other words, create an asset and then depreciate it, or should I expense it as it's incurred? And again, if it's direct, incremental, and recoverable, then you need to capitalize it. So as an example, let's say that I rebuild the engine on a truck. Well, that's a very direct cost towards using that truck. It's an additional cost, so check. And the third one, is it recoverable? In other words, does having a truck with a rebuilt engine more valuable than a truck without one? And the answer is yes. So it is recoverable. So I can capitalize the cost of a rebuilt engine. However, if I'm just changing the oil, it's tough to justify, capitalizing that cost, because is it direct? Yes. Is it incremental? Barely. Is it recoverable? That's a tough one. Is someone going to say, wait, you changed the oil in your truck? Well, my goodness, I'm going to pay you so much more money now. I mean, that's not really how it works. It's sort of an assumed, like you're going to change the oil. And so for that reason, something like changing the oil would be expensed. It's not going to be capitalized. Again, these are just examples we have to think through. Many cost accounting courses are going to give you a solid foundation in distinguishing those two. Materiality matters? Yes, I do think so, Harry. Absolutely. I think immaterial costs are going to be expensed. Material costs could be capitalized if it meets these three criteria. If you take a cost accounting class, they're going to beat this into the ground, though. So I don't spend a lot of time on it here. All right, a little more on long-term contracts. Typically, companies have to wait until their performance obligation is fully met before they can recognize revenue. That's called the completed contract method. However, there are some long-term contracts where there are performance obligations that can take a lot of time to complete. So major construction, long-term development, all those kinds of things. So under certain circumstances, US GAAP allows the company to recognize revenue over time before the performance obligation is complete. And this is using the percentage of completion method. So this is an allowable method under US GAAP for long-term contracts. To recognize revenue over time, one of the following three criteria must be met. 1, the customer simultaneously receives and consumes the benefits of the entity's performance as the entity performs. That's kind of a weird one, but imagine that I have an ongoing service agreement. Basically, as I'm servicing I'm servicing their equipment or something like that. Well, they're receiving and consuming that benefit, and so I don't have to wait for all service to be done to recognize revenue. I can do it over time as I'm performing that service agreement. So that's kind of a big one. Number 2, The company's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. So, as an example, let's say that I am a construction company and I am remodeling a building. Well, while I'm remodeling the building, the customer continues to control it. In other words, it's not like they're signing the building over to me while I'm doing the remodeling. Instead, they're the ones that keep control of the building. And let's say that I complete one floor. Well, they get to keep using that one floor that I just completed. And so I can sort of recognize revenue as I'm making my way through the process. Rather than waiting until the entire building is remodeled, I can sort of do it in pieces as I complete certain aspects of the remodel. Again, the key though is that the customer continues to control it as the process is going along. And then third, it must be the case or could be a situation where the company's performance does not create an asset with an alternative use. In other words, I'm not doing something that can be used by another customer. If I go down this path, then there's also two additional criteria that have to be met. So again, one by itself allows this percentage of completion method. Two by itself allows the percentage of completion method. Three by itself allows with these caveats, all right? With these caveats. And so it has to be the situation where I'm performing and I'm not creating an asset with some other use. In other words, I'm not creating an asset that I can sell to somebody else, all right? If I'm in this situation, then what? Then also two things. Another company would not need to substantially reperform the work that I've completed to date. And then secondly, the company, I have to have a right to payment for what I've done. I think an example for this would be, let's say that I am building a new roundabout for the city of Waxhaw. So I live here in Waxhaw. So let's say I'm building a roundabout and I'm a construction company. I've contracted with Waxhaw. I have a roundabout. All right. So as I'm creating that asset, well, Waxhaw really doesn't control what's going on there. So we haven't met number two because no one can drive on it. I'm controlling what's going on there. All right. So that's one piece of it. But let's see. But three, am I creating an asset with an alternative use? In other words, could I take this roundabout that I'm building in Waxhaw and sell it to somebody else? No, I can't do that. All right. But have I met one of these two? Have I also met these two other criteria? In other words, if I'm working and all of a sudden I stop, would somebody else have to substantially reperform the work that I've already done? Probably not. I mean, if I've prepared the ground but I haven't done anything else, they're not going to have to come in and re-prepare the ground. The second thing is if I've done that ground preparation, could I bill Waxhaw for the work that I've done? And the answer is yes. And so in that case, I would be able to recognize the revenue as I'm going along using the percentage of completion method. Again, there's lots of different examples of this. I just want to provide the general guidance to let you know that this long-term contracts usually are going to use this percentage of completion method because it's going to meet one of these three criteria. So let's do an example. 49er Construction signed a 3-year contract with the university to build a new dormitory on January 1st, 2020. The university agrees to pay 49er $10 million to construct the dorm, and 49er estimates its cost to be $8.5 million over the 3-year contract. As of December 31st, 2020, 49er had incurred $3.5 million. They estimate another $5.2 to complete the contract. They build all this different information. So in other words, how do we handle this kind of contract? First of all, whenever you're building a new dorm in a long-term contract, it is definitely meeting the third criteria, if not the second criteria. And so we're definitely in that percentage of completion method world. And so let's take this information and figure out how we would report using the percentage of completion method. All right, so first let's provide the journal entries for the work that's completed, billed, and collected during 2020. All right, let's kind of talk about each one. As I am doing the work, all right, so again, this is work that's being completed. All right, so as I incur these costs, I'm going to be debiting this account called construction in process. Simultaneously, I'll be crediting inventory, payables, cash, those things. So if I'm buying, items that I'm going to use for the construction, if I'm paying workers, those kinds of things are the credits. And as it's accumulating, it's going into this construction in process account. So construction in process is the debit, it's an asset. The credits are either to existing assets or to payables, and that's just as we're going along. If you could imagine, this is probably happening on a continuous basis. Costs are constantly being incurred and paid, and so this is the work that's being completed. At some point, I am able to bill my customer. And so whenever I bill the customer, now I have an unconditional right. If I can bill the customer, I have an unconditional right. That then becomes an accounts receivable. And in this example, we said that we had billed $3.3 million. All right, so whenever I bill the customer, I debit my accounts receivable and I credit what's called this billings on construction in process. Billings on construction in process is the credit, $3.3 million. So I have construction in process, and now I have accounts receivable, and I have billings on construction in process. Then, of course, as the customer actually pays me, I get rid of the receivable and I collect the cash. And so this is just generally what's going on. So the majority of the journal entries are in that first group, the as incurred group. That's happening a lot. And then as I bill, that's the second group, and then as I collect, it's the last two entries there, or the last full entry, the last two accounts. So, all right. So construction in process is a contra asset, and billings on construction in process is a contra account to the construction in process. So how would this get reported? All right, so now we need to provide the adjusting entry for the percentage of completion method to recognize revenue. So first of all, let's figure out the percent complete in that year. And so the percent complete in 2020, the total costs incurred is given as $3.5 million, and then they estimate the total remaining costs to be $5.2 million. And so the percentage of costs, percentage of completion based on costs, is 40.23%. And so what that means then is I can recognize 40.23% of the revenue that's part of this job. So I can recognize $4.023 million. And so what do we do then? So then we recognize the revenue from our long-term contracts, $4.023 million, and that is a credit. We're going to debit our costs that are going to be, we're going to call those construction expenses. So whatever expenses we might have, those would be various items, labor expense, whatever it might be. And then we have construction in process being debited for the difference between the two. Again, this is just how we handle long-term contracts. Recognize the revenue. Of course, we'd be debiting the cost of those expenses, and then the construction in process is a debit for the difference. So what are we going to report on the company's financial statements? On the income statement, we have the revenues, of course. We have the construction expenses, which gives us our gross profit of $523,000 in this example. On the balance sheet, we have our accounts receivable, which is still the remaining accounts receivable. Going back to our journal entries, we can see that the total accounts receivable was $3.3 million. We had collected $2.9, which means there's $0.4 remaining. So again, that's where that number comes from. Under our inventory account, we have this construction in process account, the $4.023 million. Where did that construction in process account come from? Right here we have on 12/31/2020, we had debited that account $0.523 million, and throughout the year we had debited that account $3.5 million. Sorry, I'm getting back there. All right, so that's where the $4.023 million comes from. All right, so those two pieces together, the 3.5 plus the 0.523. And then less those billings, we talked about that being a contra asset. And actually, looking back, I think I did something wrong. Hold on a second. I did. All right, so this is actually an asset. Sorry about that. All right, so under inventory, our construction in process is an asset, 4.023 million. And so then we subtract those billings, which means that our inventory is going to have the net of 0.723 million, the costs and recognized profit in excess of billings. That is the actual count. So this is what would be reported on the balance sheet. So the income statement would have a gross profit related to these items, and the balance sheet would have these items listed under their assets, accounts receivable, and under inventory there would be this net costs and recognized profit in excess of billings. Again, this is how we handle long-term construction or long-term contracts. It doesn't have to be construction. All right, so we walked through it. Like I said, this wasn't quite as long, so it was an hour 45. If you have any questions, now is a great time to ask. Again, this test, generally speaking, students do better on the Chapter 18 material, assuming the same preparation. Students generally do better. I know some of you have been struggling a little bit here and there. Hopefully this is a chance for you to rebound, but you definitely need to study hard in order to do so. But I want to give a couple minutes here for questions if there are any. Again, just a minute here. All right. Well, I don't see any questions. Keep hanging in there. If you do have any questions, email me. I do have office hours using WebEx on Canvas tomorrow, so obviously you can come to that. And then there are individual appointments on Friday if you want to sign up for one of those. All right, everybody. Take care.